Get on board, get on track, get to where you're going. And now, your edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your edutrainer and coach for our edutrainment workshops. And of course, we're doing our entry-level introduction into the life insurance series. And this whole week, we're going to be doing our introduction into current assumption universal life. Current assumption universal life. And remember, we've been using last week and this week and all the way out to the end of our course, still about 4 to 5 weeks to go, we'll be using Lincoln Benefits Eclipse software, which we voted as the most user-friendly. And if you've not been in our business especially, and you need a software package to really kind of go through as a basic tutorial, we highly recommend it. You can go out to their site, www.lblsales.com/ETW. That's www.lblsales.com/ETW. When you come out to the site, just go ahead and click on the Run Installer and download it, and then you can go with me page by page. We find it as a great learning tool, especially when you can go with me page by page. Also, another thing that our sponsor is doing, and of course, we are not only sponsored by Lincoln Benefit, an Allstate company, but they're also giving us a website which is now appearing at the bottom of your screen. It's kind of a long number, and it's on our SEO. So if you go out there and tag on our SEO, it's probably easier to get it from there as well, our search engine optimization doc. But there are several great pieces out here, absolutely free. One of them is the Facts of Your Life booklet. It's a great data collector, and several ideas like prospecting letters and some postcards. So if you say, gee, I don't even know how to talk about this. Now remember, this went through the compliance department of Allstate, which may not necessarily be okay for you. So you need to have your compliance department always check to see if this kind of language is what they're okay with and they'll tolerate. Remember also that you can go all the way back, and we've seen so much increase on our sites. People are saying, well, I need to go back to the basics. I can't just drop into Steve's course halfway through. If you want to do that, just go ahead straight out to our site. You can go to brokersalliance.com. As soon as you come to our homepage, hit our red on-demand video button, go to our archives, and again, I highly recommend start from the beginning. Each course is about 15 minutes. It's a little under 15 minutes. I know it's a lot, but for people who are educated, we're getting a lot of great feedback on this, and we really appreciate it, and thank you for it. Now, today, what we're going to do is we're going to hop out onto the whiteboard first, and I want to talk about the basic thinking here. Current assumption UL. There's the tip-off right here. Current assumption. Whatever the current rates that are being credited to this contract, that's the current number. They're not locked down. They could change. They could be variable. And current assumption also has cost of insurance. That could change. Now, both of these have guaranteed interest and guaranteed cost of insurance based in the contract. But nobody sells off the guarantees. They generally sell off the current company practice or whatever the current assumption is for the interest rate. So when I'm thinking about current assumption, UL, I'm thinking interest rate. Not dividends for like whole life, not indices like IUL, Index Universal Life, and not variable using equities. We're talking about interest rate. Permanent. If you remember this, what is a permanent product? Well, we're looking for, do I have a permanent liability? So when I'm looking at this, what's my liability and is it permanent? If it's permanent, then I want to know permanent expense reimbursement money. That's what I'm looking for. If I have a permanent need, a permanent liability, a permanent obligation, reimbursement. I like that. That's not the way it's spelled, but it sounds pretty cool to me. Expense reimbursement money, I want to know, is it permanent? And if it is current assumption UL using interest rates, whatever the current interest rate crediting is that the way to go? So always when I say, should I buy term, should I buy perm, do I have a permanent liability, a permanent economic liability that's going to go on forever? And this is one thing I always want to bring up about, remember we sell a lot of final expense products. Our biggest block of business is in the geriatric area of 65 and older. That's where most of the premium is coming from. The LIMER studies last month showed that the increase, there was not that much increase in life insurance, but the sector that it was increased was in the geriatric demographic. So my thought is some of these people probably had these permanent liabilities from the get-go, but they bought term instead. Now they're buying a higher priced permanent contract for whatever their needs are. So permanent expense reimbursement money, if I know it's going to be for the rest of my life, if I'm going to have issues like final expense and so forth, I'm going to take care of all that by using a permanent product. This is one of the 5 different chassis that you could buy, current assumption UL. Now what I'm going to do is I'm going to walk over, and this is a piece of one of our scripts here from our life manual. And remember, if you want to say, Steve, I'd like to have that life manual plus our vocabulary that we've been talking about, just ask me for it. Write me thebiz@brokersalliance.com. That's thebiz, THEBIZ at brokersalliance.com. We'll send you the life manual as well as the patented vocabulary, which we think is really important because then you can set it aside, look at that. Why I'm talking, if I use a term, you say, well, I don't remember that term, you can go right to your vocabulary sheet and pull it up, and it's really a great piece. Just order it, thebiz at brokersalliance.com, and I'll send it to you. This is a document that we have here. It's what is universal life. If you're looking at current assumption UL, which this basic boilerplate does, it's a nice basic explanation. And if you say, gee, I would like to have that and be able to talk through the talking points, this is an excellent one. Universal life really differs from whole life by separating out and identifying all the moving parts. Later on in the week, we're going to get to all the moving parts. We're going to show you on a spreadsheet all the expense loads, completely unpack it. Whole life has some of these things all built inside it, but it's kind of already put into kind of a single department. There's no way to really break it out except for the dividends, which are not guaranteed. We'll get into that though, because there's reasons why we're going to use whole life. And here we're talking about being able to specifically identify policy provisions, policy fees. We're going to be able to do our front-end load. What are the loads, if any? We're going to be able to look at the cost of insurance, the interest credited, all that's spread out on a balance sheet. And I think if you really want to see, hey, what's the mechanics here? That's an excellent sheet. We'll get to that at the end of the week. One of the examples you're looking at here is that this is universal life, and those charges that I talked about that we'll look at the end of the week are coming out monthly. They're doing it for the mortality element, the expense element, the policy, to get down to a policy account balance. So I have to pay all my expenses first, and when I'm done with my expenses, then I can credit the interest rate to that contract. Now, if I'm using this as a death benefit play, many current assumption ULs now use a liquidity rider. So if there's any kind of, hey, I may need some extra cash, or I want to be kind of rewarded for staying in the policy for 15, 20 years, many of them have liquidity riders, including Lincoln Benefit, our sponsor. So when I'm looking at these kind of liquidity riders, that could be a great play if you wanted to use current assumption for income scenarios. So it could be used for indemnification, and it could be used for income, and when there's no second to die play for inheritance, this could be an option. There are some other options, but this might be an option. So when I'm looking at this, it gives me my first idea, or my first graph. The graph here basically is depicting 3 parts in a type 1 or level death benefit scenario. There are several other ones that I'm not going to talk about in our class because I want to stay rudimentary and basic, but basically level death benefit or increasing death benefit. If you'll notice, the blue line is depicting the death benefit, which stays level. Now, in an income scenario, if we suppress the death benefit, that actual death benefit would start to go up to hug what we called the DEFRA corridor, cash value pushing it up. But in this example, we're just paying out the premium. The premium is identified in this red line going horizontal. The actual death benefit is the blue line on the top, parallel. And then the interesting thing, the cash value starts to climb and exceed the cash value, or exceed the premium. But then what happens is it starts to go to the place of maturity. If we paid all years at the current assumption, those cash values could get so close that at the time of the maturity of the contract, depending upon when it is, that could be 10 years, age 100, it could be all the way out to age 120, depends upon each policy is going to be different. I'm going to see cash values build up over those years, and they could get so close that it endows. The death benefit actually equals the accumulated cash value. Again, it depends upon when that's going to occur by the maturity date. Now, here's the second type, increasing death benefit. This is also known as option B, but I don't want you to learn option A and option B language because there's still carriers that have not standardized their boilerplate to the industry. So it's better to just say, the first one we looked at is level death benefit. The second one we looked at is increasing death benefit. Now, interesting, still using the same color coding, our annual premiums are shown in red, level. Then we notice that we have a death benefit and a cash value. What's happening here is these generally pay the face amount, whatever the face amount we ask for, and the accumulated cash values shown in the green. They can kind of parallel because they're going to push up the quarter. Again, if I was going to use this for an income scenario, I could ask for the maximum funding on this, and that corridor would be a lot closer as we get farther out. So what I'm always trying to do, especially in an income scenario, is to keep the death benefit, suppress it, and use the right option so my cost of insurance is the least amount. But in this example, I'm using increasing, or sometimes, again, they use option B, but again, I want you to use the term increasing. And these are the three basic components: my annual premium level, my cash value growing, and my death benefit, kind of in this example, paralleling that. Now, some of the common uses we've talked about already, and we've been saying family protection, of course, indemnification scenarios or coverage scenarios. And then business planning. Some people really like this because they use current assumption UL as a sinking fund for corporations that they can tap into. Maybe the two partners have one on each one, and they could have it inside cross-sell or cross-owned by the company or owned by themselves, depending upon how they want to do it. But sometimes they'll use this for sinking fund or just basic buy-sell agreements. Accumulation needs, as I said before, a lot of people like tax-free income if the policy is kept in force for the life of the insured, and we do all the proper management of the corridor, the TAMRA, buying the most suppressed, lowest possible death benefit we can. We can generate a nice accumulation and then an income. And then some people like to actually use these products as charitable giving, especially at the lower end middle class, where people say, I really don't have a lot of money to give to my kids or my grandkids, or the charity of my choice. I'd like to bless them, but I just don't know how. Sometimes the leverage of life insurance using cash value accumulating UL is pretty good because I still have access to it, but the death benefit's there to provide for people that I want. Maybe it's, again, my children, my grandchildren, or the charity of the choice. And then when I'm looking at this, remember, single deposits in current assumption products of UL are going to be treated as modified endowment contracts for everything that's been issued after June 21, 1988. So just be aware that if you want to do a single deposit on this, which you could do, just remember, it now is going to be treated very much like an annuity. It's going to be a taxable event on taking all the gain out. The gain's going to, if anything comes out first, the gain, if there's gain in the contract, it's going to be treated as an ordinary income tax event. But the death benefit still could transfer to the beneficiaries free. So that's kind of a little edge that it has over annuities. Do you want to do single deposits? Sometimes certain carriers give direct recognition, give you a little bit of discount. You're hitting certain areas of break points and death benefits, and they may actually give you a deal for actually giving your money now. And especially when you consider today, our low interest rate environment, money markets paying zero, hardly anything, barely zero. We're looking at low rates and certificate of deposits. Sometimes the leverage play here using a current assumption UL product could be a great alternative. You're really not making anything on the side funds. You still have access to this depending upon how sizable your estate is and other issues. It's just a thing that you want to consider. And some of the last additional policy elements, I have surrender charges, of course. Everybody's all over the map on this. Certain carriers might be as small as 10-year timeline. Some carriers go all the way out to 20 years. It depends upon how they're accumulating. I've noticed that some carriers actually will give a better accumulation number if you're willing to hang in with the policy longer than usual. So you have to look at that. If I'm really going to be able to have access to this, and I really don't need it for 15, 20 years, don't be afraid of the surrender charges because they may be protecting a better deal. Just look at the timeline. It'll show it to you on all the illustrations. Remember, you'll be able to take policy loans out, but depending upon the type of loan, whether it costs you or not, whether it's consumer friendly or partial withdrawals, all those issues are going to be looked at because of maturity dates, and also, especially on withdrawals, do I have gain in the contract? Am I taking it out in the first 15 years? I may be subject to ordinary income tax. And then remember, I'm going to have surrender options. I could annuitize this, even though most people say I would never do that for income. I take withdrawals to basis and policy to loan, but I could annuitize it. Those are our options.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.